Welcome to Global West. Please subscribe and hit the bell icon for more breaking updates. I bet you didn't know that several major economic powers are quietly cutting exports to the US, setting the stage for a seismic shift in the global economy. Today we're diving into a major shift in the global economy that could impact us all. Several major economic powers are quietly cutting exports to the US, raising big questions about the future of global supply chains. But while these 7 key nations are pulling back, Canada is doubling down, signing a massive billion-dollar deal to strengthen its partnership with the US. This contrast could redefine North American trade for decades. What does this mean for you and the US economy? We'll break it down country by country. We'll look at who's cutting exports, why, and which industries are feeling the heat. From tech to autos, the ripple effects are already here. We'll also explore the Canada deal and its potential to offset these new challenges. Stick with me as we unpack this complex story. Let's get started. First up, China, the world's manufacturing powerhouse. For decades, made in China fueled American consumerism, but that's changing fast. China is deliberately reducing exports to the US, aiming for economic self-sufficiency and less reliance on foreign markets. Electronics, semiconductors, furniture, and textiles are all seeing slowdowns. US companies now face bottlenecks and higher costs as they scramble for new suppliers. China's government is pushing manufacturers to focus on Southeast Asia, Africa, and Belt and Road partners, shifting global trade flows. Trade wars, tariffs, and mutual distrust have deepened the divide. Internally, China faces economic challenges and is turning inward to stabilize. The result? Higher prices and potential shortages for American consumers. Companies are forced to reroute manufacturing, passing costs down the line. This is more than economics, it's a geopolitical realignment. China is building an economic fortress, and the US is on the outside. The era of hyperglobalization with the US at the center is ending. The implications for American supply chains are massive. This is just the first piece of a much bigger puzzle. Now let's look south to Mexico. Long seen as the ultimate nearshoring partner, Mexico is now selectively cutting exports to the US. The motivation? Greater autonomy and less dependence on the US. Automotive parts and agricultural goods are most affected, with Mexico redirecting exports to South America, Europe, and Asia. US automakers face delays and higher costs, while American supermarkets could see price spikes on staples like avocados and tomatoes. Mexico isn't cutting off the US, but rebalancing its trade portfolio for leverage and growth. This is a strategic move, not hostility. Mexico wants to play on a bigger stage. The US must now adjust to a neighbor that's both partner and competitor. The North American trade dynamic is changing fast. Across the Atlantic, Germany is scaling back exports to the US. This isn't weakness, it's a calculated response to economic pressures and shifting priorities. German automakers and machinery producers are focusing on Europe and Asia, where growth prospects are stronger. Soaring energy costs and fierce competition in electric vehicles are driving this pivot. Germany's legendary industrial equipment is now heading to Southeast Asia and India, not the US. The EU's push for strategic autonomy means more trade within Europe, less with America. Regulatory changes like the carbon border adjustment mechanism make US exports less attractive. The message: Germany is consolidating strength at home and in new markets. For the US, this means higher costs and less access to high-end German goods. The era of easy transatlantic trade is fading. Next, Japan, a longtime US partner, is quietly reducing exports. Aging demographics and a shrinking workforce limit production, forcing Japan to prioritize markets with better growth and stability. Japanese automakers and tech firms are focusing on Asia, strengthening regional supply chains. Currency instability and trade risks make the US less attractive. Japan is investing in hybrid tech and next-gen batteries, sending their best products to markets with favorable regulations. Geopolitical tensions in the Indo-Pacific are pushing Japan to build alliances closer to home. The US can no longer count on a steady flow of Japanese cars and high-tech components. Japan's strategy: stability over risky growth. The US must look elsewhere for vital goods. Another pillar of the old trade order is shifting. South Korea, a tech powerhouse, is also recalibrating its export strategy. Electronics and steel exports to the US are down as Korean giants prioritize R&D and regional partnerships. Fierce competition in semiconductors and display panels means advanced products are going to markets with better returns. Steel producers are targeting emerging economies in the Middle East and Southeast Asia. Domestic economic pressures and high household debt are driving Korean firms to diversify away from the US. Over-reliance on America is now seen as a vulnerability. South Korea isn't turning away from the US, but is hedging its bets for the future. The US can no longer take Korean tech and materials for granted. The supply chain puzzle just got more complex. In South America, Brazil is shifting its agricultural exports from the US to China. China's massive demand for soybeans, beef, and raw materials is pulling Brazil's economy into its orbit. Brazilian producers are investing in infrastructure to serve Asian markets more efficiently. Political alignment with the BRICS bloc is also a factor. Brazil is seeking a multipolar world, less dominated by the US. For American consumers, this means higher food and raw material prices as Brazil's supply shrinks. The US has relied on Brazil to fill supply gaps. Now that's changing. Brazil's pivot is both economic and geopolitical. In the global commodities market, business follows the biggest customer, and right now, that's China. The US must adapt to a new reality in food and resource supply. India, the world's pharmacy, is reducing exports of generic drugs and textiles to the US. The Make in India initiative prioritizes domestic needs and advanced drug production over low-cost exports. Indian pharma companies are expanding into Africa, Latin America, and Southeast Asia, reducing dependence on the US. The textile industry is also pivoting to the EU and Middle East for higher profits and more resilient supply chains. India's ambition: move up the value chain and become a global power, not just a supplier of cheap goods. For the US, this means less access to affordable medicines and textiles. Healthcare and retail sectors will feel the pinch. India is building a self-sufficient economy and independent foreign policy. The US faces new challenges in securing essential goods. So what's the bottom line? These export cuts signal a seismic shift in the global economic order. The US is no longer the undisputed center of global trade. Expect rising prices, supply chain disruptions, and more competition for essential goods. But there's hope. The billion-dollar Canada deal strengthens the North American trade bloc. Canada's commitment could help offset shocks and serve as a model for future partnerships. The global trade map is being redrawn before our eyes. What does this mean for your industry or daily life? Let me know your thoughts in the comments. Thanks for watching. If you found this valuable, like and subscribe for more deep dives. Stay tuned as we track the forces shaping our world.